case for further rate cuts.
No.
The absence of that phrase is very important. Aditya Narain of Edelweiss is also with us. Aditya Narain, looks like rates should not dip any further. That seems to be one takeaway. Would that change your view of interest rate sensitives, realty stocks, housing finance companies, NBFCs?
I think at some level, the rate cut cycle was in any case flagging. I think the risk this time around was that the commentary would be a little harsher than it has been. So I think to some extent it doesn't ruffle that feather at all. I think the other thing with sectors like the financials basically is that, the interesting thing with this policy is there's actually very little conversation on asset quality, right, which has been the focus of a lot of credit policies over the last couple of years. And to some extent, I think, as far as banking stocks are concerned, I think you're moving away a little bit from the rate element to what's happening to asset quality and when you're actually going to look out to growth. And the absence of conversation on asset quality, in my view, to some extent, suggests that there's some stability there. It's not the risk it was perceived to be. And I would say at the end of the day, that provides a certain amount of support to these stocks rather than worrying too much about the rate cycle coming to an end.
Yeah, you're absolutely right. He didn't mention about asset quality at all. And there were some economists who were worrying that this too cheap money might lead to mispricing of risk. But the governor said none of that. Let me ask Ashwini Bhatia that. Ashwini, you were very clear that rates are not coming down further. Is there a chance that you all will hike any part of the curve in terms of lending? And because of this TLTRO being available and of course oodles of money in the interbank market, is credit offtake likely to increase?
So if we are not seeing any signs on the corporate side, the demand there still is pretty muted. And on the retail side, I think we have to be with the markets. The liquidity being where it is, I don't think there's any scope right now to reduce further for sure. Having said that, I think...
about upping, Ashwini, home loan rates, I don't think even in the previous cycle went below 7. If I remember right, yeah. 7 was the least I saw. Now we are getting for 6.9 and 6.75 also. And some of my colleagues who are, who have it tagged to the T-bill are paying as low as 5.9 for some EMIs. So will they rise is what I'm asking.
So if they're at 5.7, I would urge them to start hedging. They won't remain there for too long. And 6.7, 6.9 is a pretty good rate if you ask me. Depending on market conditions, and I'm sure for the next 6 months at least, the rates are not going to go up. I think that is the guidance that the monetary policy has given us this morning, to say that till March at least, looking at the uneven growth that they have seen, they'll be patient, but they'll not disturb liquidity also at the same time. The deposit growth still remains robust, although it's muted a little bit in the last couple of months, but that doesn't mean that we'll increase rates in a hurry.
Mr. Renu Kohli, apologies for keeping you waiting this long, and we appreciate your patience. What was your reading of the RBI statement? Lower for longer, but no rate cut anytime soon.
First of all, thank you very much for giving me the opportunity to air my views. I'm not at all surprised at the monetary review, because it was pretty much expected from the October's review, the commitment that they had given about continuing the accommodative stance into the next financial year, at least the early, as long as we had for which we had the projections in October. So RBI has done well actually to reiterate its accommodative stance into FY 2022 and not to be bothered too much about the excess liquidity. It's just at the short end of the curve, and which is directly under the central bank's control. It can reverse it or it can tighten it anytime should it feel the need. About inflation, it's for the government to actually attend to the supply side pressures. I don't think that the Reserve Bank can do much about it. What they have to worry about is core inflation. it was going downward, and they will be watching it very, very carefully. The trouble is that it is a very uncertain time, even globally, about what the inflation outcomes could be, whether they would be in the temporary or persistent, because there is a lot of pent-up demand which is coming back, and so there is a bit of difficulty in understanding exactly the outlook for inflation. About its growth focus, the MPC was had in October itself said completely focused upon growth, and they have maintained that, which is a good thing. They have maintained this thing, and it will continue. So that sends very positive signals across, and it doesn't disturb the economic environment at all. I would worry about one thing, which is the credit demand. Now that's where the monetary impact needs to show itself, and we haven't seen any kind of response so far, because the economy and particularly the supply side is still recovering from the lockdowns, and the unlocking is still taking place. It is understandable the last 6 months. My worry is actually the exceptional easing measures, starting with interest rate cuts and the TLTROs, predate the pandemic, and from early 2019 and December 2019 in particular, a lot of OMOs, everything has happened. And yet there has been no response from the credit demand side. In fact, if we ended the March 2019, the 19-20 year, with credit growth actually just decelerating to half of that over the previous year. It was something like 6.7%. And that's where the real worry concern lies.
Absolutely, and that's what our bankers are telling us. Ashwini says, where is the demand for credit? So it's not really so much the cost of money or the availability of money. Mallikarjun Rao, final question to you. Do you think interest rates, lending rates will go up at all? And or you just see them remaining flat for now, and credit growth?
Interest rate will be flat. I don't expect interest rates to grow further, though they will not go down. Now, regarding the credit growth is concerned, if you have seen, mid-time industry, mid-corporate industry and services industry, we have seen good amount of growth year on year to the extent of 16% and 10%. Whereas in the large corporate segment, the demand has been very muted. So while we expect the festive impact to continue, sustain up to March, but the critical mass increase comes only in the corporate industry. So we have to wait and see how the demand comes up for credit growth.
Okay. Well, thank you very much, Mr. Rao. Anand Bagri of RBL has also joined us. Anand, are you sitting in front of a screen? Most people have joined us from home, and so they're not able to tell us whether the TREPS rate, the CP rates up to 3 months have fallen or remained static. What has been the impact?
So the markets were already pricing in because of this huge liquidity glut which is there in the market. So I believe that the markets are flat as of now. There has been no major change in the markets. Maybe a couple of basis points, 2 to 5 basis points here and there. Otherwise, the markets remain flat.
India is down by about 5 basis points. It was at about 5.93 also in the morning. Now it is at 5.8990. So about 3 basis points lower on the 10-year. But anything in the shorter term at all?
So on the shorter term, the markets have been more or less flat. There is no major movement seen on the shorter term, Lata.
Okay.
So yields were down by 3 to 5 basis points there also.
All right. So Aditya Narain, therefore to you, do you think now the equity markets have got a clean chit from the RBI that rates are going to remain low, and you think this will further fuel the rally that's already hugely underway?
Yeah, see, I think you already had a very, very strong rally. So I think to some extent, I think there will be a certain amount of leveling off. I think the message that, as I mentioned initially, was that one, I think asset quality seems to be a little bit of an issue of the past. So I think that provides a certain amount of relief. The second thing is, I think transmission is happening well. A lot of commentators have mentioned that there hasn't been enough demand. The reality is transmission is tending to happen. I think the third thing is, and I think, this is an overlay from what the governor has said, is that there is a reluctance to go against the global easing that you're effectively tending to see. And I think as long as that stays, you will end up getting a reasonable amount of support for the market. But I think specifically for this policy, I think the fact that the commentary remained dovish, I think would have been more a relief rather than anything that will necessarily on a sustainable basis drive the markets at this point in time. I think one needs to keep in mind the fact that a lot of the market performance that you've seen has been really a global overlay of markets being strong and of both fiscal and monetary policy being very, very decided, right? I think as far as India is concerned, from a monetary perspective, you are getting support. From a fiscal side, there probably would need to be a little bit more. So bottom line, I think this reassures the market. I'm not sure if it's enough to really sustain or provide a next leg of a kicker to the markets.
Okay, Anant, final thoughts from you. What is the sequence of events you see from here on? Perhaps a more neutral tone of the policy, a CRR cut, a reversal that is expected in March, reduction of the reverse repo corridor, then perhaps a hike. What's your sense?
So Ritu, very quickly, the short-end markets, actually the yields have come down by about 5-6 basis points on the OIS market at least. So there is a bit of a relief going through with the accommodative stance and the fact that the RBI has not said anything about withdrawal of liquidity, etc. Going forward, things are going to get tougher, Ritu and Lata. Inflation is looking very uncertain. We hope that productivity improves. We hope food prices come down. But as the corrections done to the inflation estimates show by the RBI, the trajectory is not looking good at all. Okay. Now we are going to see a growth recovery as well. We know that. Q1 of next year we will see a growth recovery, and hopefully credit offtake takes off as well. And by the way, the fiscal deficit will remain. It's not going anywhere the next fiscal year. We will still see a fiscal strain, and we will see the need to finance a fiscal deficit. And as Sajid mentioned, we will see FX inflows coming through as well. So it's going to be a very funny and toxic kind of mix of parameters that you have to juggle with going forward. I wouldn't be very sure about the quick withdrawal of liquidity, etc. RBI will play it one thing at a time. Right now, they're very focused on growth and giving growth a chance. Depending upon how things pan out from here, they will, I guess, take a call on what needs to be done. I'm guessing that yields will have to move up the next financial year, but it will be a very, very delicate balance.
Okay. Anand, besides your FX question, what is the one question you want to ask the governor?
Plenty of questions. And the point you made
You get only one.
I guess the internal working group, on banking, I can think of 10 questions on that. And I'm sure
absolutely. That will dominate the conference, I would assume. Neeraj, what's the one thing you would want to hear from the governor?
I think clearly we are in a wait and watch mode as far as the MPC is concerned, but exit from liquidity is something that the market will need some clarity upon. There was nothing in this policy. At some point in time, they will have to tell us that how do they plan to taper this off and how slowly and gently this can be done. Because that is going to determine as far as the course of interest rates in the real economy is concerned, right? While bond yields may actually react to the repo rate and the changes in the policy rates, but the liquidity which determines the real rates in the economy, the deposit and lending rates. So I think clarity on that going forward in the next, I would say, next policy, what's the timeline around it, is the key thing that I will watch out for.
As of now, as a man heading a large treasury which buys bonds regularly, you think now there's no danger to the RBI, to the government's borrowing?
I think we are in a very stable 5-10 basis points volatility, rates regime right now for the time being over the next 1.5 months. And I think this is very supportive of issuance both by the government as well as the corporate sector. So I think I would see the next quarter a good amount of issuance activity from corporates as well.
Okay. Gentlemen, thank you very much. Gentlemen and Renu Kohli, thank you very much for joining us and help us parse the Reserve Bank Governor's monetary policy statement. The key takeaway is that the MPC and the RBI have leaned in favor of growth over inflation. They have upped the inflation forecast, but they're at the moment not doing anything about it without saying they are looking through the